Good evening, everyone, and welcome to our monthly webinar. So let's start with the portfolio performance across all our schemes, starting with Coffee Can. Yeah. So it was a good month for Coffee Can with a 1 month return of about 4.4% compared to benchmark of about 4%. The key performers during the month of July were KFin, HDFC Life, and Zomato. These were new introductions in Coffee Can over the last 6 months, and they have done really well over the course of the last 6 months as well. The bottom performance was from HDFC, Nestle, and Britannia. If we move to Good and Clean, so Good and Clean also did very well for the month. The return for the month was close to about 5.7% versus 4.4% for the benchmark. The key top performers for the month of July were Deepak Nitrite, Ajanta Pharma, and Emphasis. Clearly, the changes which Trilok has done on the Good and Clean side in the last 1 year are sort of visible, with the 1 year performance also being extremely strong at about 50% compared to 38% in the last 1 year. The key drivers to the portfolio were Supreme, Axis Bank, and Aegis Logistic. Coming to emerging giants also did well in line with Good and Clean, returning close to about 5.7% in the month compared to 4.4%, which is benchmark. This is a portfolio where we've done a lot of changes in the last 6 months, and slowly and steadily the performance of the new contributors has started to kick in. So if you look at the top performers for the month of July, we've got Tips, VMart, and TeamLease. They have sort of delivered fairly handsome returns in the month of July. In fact, if you look at the month of August as well, thankfully, these stocks continue to sort of do well. In terms of the bottom performers were Mass Financials, Alkyl Amines, and Rosari. If we move to 10x, 10x also had a very good month with close to about 6% return last month, compared to 4.4% for the benchmark. The key contributors have been Orchid Pharma, Emphasis, and PI. Orchid obviously is a new entry, and that has done well as far as the stock is concerned. The bottom performance were Astral, Aegis Logistic, and AU Small Finance Bank. Obviously, we'll discuss individually a few of these stocks as we get into the Q&A mode. But let's come to the newsletter which we wrote in the month of July. So the theme is Capex to consumption. This is going to be a big differentiator as far as the returns in the next 1 year is concerned. So if you look at the last 1.5 years, we've seen a lot of stocks related to the Capex theme, which have done very well. And if you look at the kind of government action in terms of Capex, they have really pumped the engine as far as pumping up Capex is concerned post-COVID. So if you look at the kind of Capex CAGR number over FY21 to 25, it has been almost 2x. So the CAGR in Capex has been almost 21% over FY21 to 25 compared to 11% over FY15 to 20. So there has been a lot of emphasis from the government. In fact, the number has almost more than increased by 2x from about 4.3 trillion to about 11.1 trillion during this period of 21 to 25. So clearly the government had significantly revved up the engine as far as Capex is concerned. And you can see it from the chart below where the number in FY21, which was 4.3 trillion, increased to about 11.1 trillion. In fact, as a percentage of GDP, it went up from about 2.1% to 3.4%. And the key sectors which sort of benefited from the Capex push have been renewable energy, roads, railways, housing, and water. If we move on to the next slide. So clearly, I mean, the consumption part of the sector has sort of seen a stepmotherly treatment compared to the capex sectors. And you can clearly see that in terms of numbers. Over the last 5 years, the government spending on rural and agriculture sector has actually remained flat at 3.9 trillion. So the number to watch out for is that the number 3.9 trillion has remained flat over the last 5 years, and resultantly, you can clearly see in the chart which we've circled that there's a yawning gap now between the government capex and the rural spend in terms of percentage of GDP. So whilst the rural spend as a percentage of GDP is just at about 1.6, the government capex number has actually doubled to about 3.4 compared to the spend done on the rural GDP. So clearly, the government completely reduced the focus on rural and actually started pumping up capex. But as a result, what happened was in the recent elections, they sort of lost out a lot of vote share as far as the rural or the semi-urban areas is concerned. So if you look at the buildings on the right-hand side, you can clearly see that the share of BJP in the recent election has actually reduced a lot in terms of number of seats won compared to the 2009-19 period. So if you look at the gray building, it is 2019. And if you look at the red building, it is 2024. So across rural and semi-urban areas, you can clearly see that the BJP government has lost seats. And that is what is hurting them, the fact that they did not focus a lot on the rural spending part. And as a result, given the upcoming elections in India across various states like Maharashtra, Jammu Kashmir, Haryana, Jharkhand over the course of next 6 to 12 months, we believe that the government is now looking at disproportionately increasing capex towards the rural spends. And historically, the sectors where they incurred capex, like railways, infrastructure, roadways, will obviously get significantly reduced. So if you look at in terms of numbers, compared to a 20% plus CAGR, which we have seen in terms of capex over the last 5 years, that number has now reduced to single digit. So if you look at sector wise, roads and railway capex is now budgeted to increase at a very small pace of 3.5% and 2% in this year. And infrastructure capex is also budgeted to grow at single digit rate of about 8.1%. So clearly, in the recent budget, the focus seems to be on becoming more populist and spending more on the driving the consumption rather than sort of the historical last 5 year sort of focus on the capex related items. So if we move on to the next slide, as a result, what is likely to happen is that the so-called neglected sectors, especially on the rural side, like the two-wheelers, the tractors, in fact, mass retail, apparel, etc., is likely to make a significant comeback. So if you remember, in the month of February, we had written a newsletter highlighting that it's only a matter of time that the rural spending will make a comeback. And that's why we sort of took a lot of call that we'll start buying companies which are more focused on the rural spending. So example being, we loaded up on TeamLease, VMart, Aegis Logistics. So few of those calls have sort of really worked well for us. And we believe that the next 12 months there will be a significant change in terms of trends from the capex related theme to the rural based kind of theme, or for that matter, the consumption related theme. So, in the next slide, you can clearly see the kind of money which is made. So, if you can just move on to the next slide and again come back. Yeah. So if you look at a few of the stocks that you can see on the screen, clearly there is a lot of shift in terms of sector allocation towards consumption. So if you look at stock prices of Page Industries, Vector Food, DMart, VMart, you can clearly see that in the last 1 month, there has been a complete shift in terms of movement across these companies, which are hitherto known as the consumption place. So that is what we wanted to highlight, that possibly in the next 12 months, money might not be made in capex related themes if you were to sort of compare it to the consumption kind of theme. So if you just go to the previous slide, what we are trying to highlight is that sort of quality or bottoms up stock picking will now make a comeback. And this will clearly, in our opinion, be led by the consumption theme. I'll now hand over to Trilok, which will take you through the macro and the market update. Yeah, over to you, Trilok.
Yeah, thank you, Bhargav, for taking us to the most important sort of topic that coming around our mind, that after a very sharp outlay on the capex, will the consumption revive? And if yes, which will be the biggest beneficiary for the country? Moving ahead to what's happening in the country, to just take you around what's happening globally. I'm sure a lot of us must have read about the volatility that happened in the market last week, and there were two main reasons for that to happen. One, what Bank of Japan, unexpectedly raised rates from 0.05 basis points to 25 basis points. This was almost this sort of hike has never happened in the Japanese central bank history in the last 3 decades. There have always been a 5-10 basis points increase, but 20 basis points of incremental has been very rare. So what that means is, as we are all aware, that the Japanese bank has usually kept interest rate at 0% levels for the last 3 decades. And that tendency of very low cost or zero cost of borrowing has led to investors, borrowing in Japanese yen and investing in dollar assets, primarily for US 10-year GSEC or treasuries. And that consistent spread has led to investors making a large sums of money across over a large period of time. Because of this event, when the Japanese central banker took not only raised interest rates but also reduced the repurchase bond program that they wanted to sort of, which means they want to suck out liquidity in the market. Basically, that led to some fluctuation in the currency of Japanese yen to USD. So just to give a context, in the last couple of months, the currency has appreciated against the USD, and which basically means not only the borrowing cost has gone up, but also the investing that the Japanese yen would have done in dollars or other currencies, they have led to mark-to-market losses in double-digit terms. To give a perspective, globally, around $4 trillion of yen carry trade is already sort of outstanding as on 30th June. To our mind, not more than 10%, 15% will obviously sort of unwind over the next 6 to 12 months, given the history. And on the bottom right of the chart, you can see what has been the usual impact. This is not something new. Over the last 2 decades, as you can see, there are several instances where the yen unwinding of carry trade has happened. But if you look at the currency, has been a meaningful sort of impact. When you see in most scenarios, the currency has appreciated by 10 in double-digit terms, and US has been the most significant impact because that's where the money flows into and not necessarily to emerging markets. And which is why Nifty during this time has not significantly corrected. In fact, out of 5 or 10 instances, Nifty has delivered a positive sort of outcome to this particular event. So we don't think that only yen carry unwinding is necessarily a very negative news for the Indian economy and in perspective. Because please bear in mind, India capital inflows is not dependent on what's happening in the US, or the European, or the Japanese in central bank. With that, I will move on to what's happening in the US markets, because this is one thing that we have been discussing for some time ago. There has been a very, very strong consensus that the US economic, sort of has slowed down dramatically, given the fact that we have seen recent revisions of labor market and the job unemployment data been sort of revised downwards. Not only that, given the inflation also is now meaningfully under control, there is a very, very high probability that the September meeting will obviously see a rate cut after almost 2.5 years of upward movements of the interest rate hike in the US market. Now, the way to think through it is, usually rate cuts. Obviously, this is the first quarter. September is the first rate cut, but in the next 12 months, there is a series of expectations that the rate will obviously keep dwindling downwards, as you can see on the on the right side of the chart. Uh, what does rate cut means for the equity markets in global? Moving ahead, when we see markets usually has not taken very constructive signs of rate cut, primarily for two reasons. A, rate cut need not necessarily means lower cost of capital and and therefore allocating to riskier assets like equities and commodities, but it also is an indication of a reasonably looming recession or a very, very meaningful slowdown in the economy as a whole. Now, obviously, this is just to give you a perspective of what is the history. The history, if you can see, there has been a very sharp decline in the markets during the rate cut in 2001, 2008. But one thing we also want to share, what is very different in the equity markets versus the last cycle. So in December 07, we have taken a few sort of important parameters to look through. The valuations obviously is broadly similar to what we were in the last cycle, in terms of price to book, on P multiples or market cap to GDP. But when you look at the quality of the growth, whether it's free cash flow to sales, whether it's leverage, there's significantly deleveraging has happened, or you look at the profitable growth and the revenue growth for the companies, you can see this cycle is fairly more benign and better than the last cycle. Also, given the fact that we are at a very, very low leverage position this time around, you haven't seen meaningful sort of impact on the interest rate hike that we saw, particularly in the last 18 12 months 12 to 18 months, both domestically as well as globally. Coming to most important parameters here is that the net FI and the domestic flows continues to support the market, with the FI not being very active in the market in the last 12 months or so. Now, also, usually when the broader developed markets goes through a difficult time, which is a rate cut and the subsequent recession that the most economists are predicting, how is India ranked compared to the global markets is very relevant from both the fresh capital from a FI point of view and B, attractiveness of the Indian economy, both in terms of economic as well as the markets. So when we have just sort of compared a few economic indicators for India versus the global markets, and you look at in most parameters except for the CPI, which is inflation, in most of the parameters we are in the top quartile. Whether it's GDP, whether it's forex, whether it's debt to GDP, or even for that matter is your forex reserves. So we think any sort of volatility, particularly which going to be might witness because of USD and appreciation or interest rate cut in the US, I think so the ability for the country to withstand that volatility better than the history is far, far superior for the Indian economy compared to other emerging markets. With that, moving to next, on what's happening on the domestic ground, as you would appreciate, as you all know, we are in the midst of earnings season, and the earnings season so far has not been very, very exciting. Earnings for the Nifty so far has been only 7% growth in revenue terms for the quarter has so far, and the expected PAT growth for the quarter For the Nifty is going to be 5%. Overall, BFSI and auto continues to deliver exponential growth in this quarter again. But we think, given the fact that the margin compression in the banking sector is going to kickstart as we progressively move ahead, and also from auto will obviously come under some pressure from earnings growth because of the steep margin expansion that we witnessed in FY24. So we think incrementally going forward, both the Nifty and the mid and small cap indexes may not necessarily deliver exponential growth that we saw in FY24, and 25 could be a low double-digit sort of growth, trajectory for the indexes in totality. Moving ahead from what are the earnings to what are the valuations, as you would see right on your chart, in the PE ratio, we are still around long-term averages around 20 and a half times. But from a price to book earnings perspective, we are obviously a marginal premium around 15% compared to long-term averages. But the one thing to notice is about the balance sheet improvement. Obviously, we are sitting at a decade high ROEs plus with a very, very low leverage, as we continuously highlight that given the fact that the core profitability of the business is at a decade high, price to book has to be looked in conjunction to what has been the historical ROEs. So with that, we would like to obviously open the floor for Q&A session, and I would comment my sort of comments on the macro part.